ServiceNow is down by over 15% from its all-time highs that it achieved in January, meaning less than a month ago it was selling for above $1,150 to today selling below $1,000. That is a massive decline of 15%. So naturally, a lot of you guys are wondering, is this the right time to buy into the stock or should you wait for a further dip? Luckily for you guys, that's exactly the type of stuff I do on this channel. We're going to analyze and theorize what the stock price could be by 2030, and if it's in the position to give us 2x, then we enter the stock, or else we skip it. But before I get started, please hit that like and subscribe button. And with that being said, let's get started. These are its current metrics. For us to get a stock price for 2030, we need to analyze and theorize what these metrics could be by 2030. For example, what the revenue could be, what the profit margin could be, the number of outstanding shares, could they increase or decrease by 2030? Let's get started with the revenue. Its revenue is one of the most beautiful things I've seen in my life. 5 years ago, it was making 3.4 billion to today making almost 11 billion. However, you do start seeing a bit of a problem. At the initial stages, it was growing above 30% every year to today growing about 21%. Now, 21% is still really high, but it is selling for an insane multiple at the time of this making. I think it's above 60. So growing at 20% with a 60 multiple, it's a bit concerning, but let's see what its revenue could be by 2030. For that, let's go ahead and jump on to ChatGPT. So of all the analysts that ChatGPT research, all of them predict a revenue of about 19 billion by 2027. Based off of historical trends and historical growth patterns, ChatGPT thinks it can have a revenue above 34 billion by 2030. In my opinion, that's reasonable. It's not too high, it's not too low. It's already 3x in the last 5 years. It's on the path to potentially 3xing again. So I'd say 34 billion, reasonable. Gemini thinks it can hit anywhere between 25 to 26 billion by 2030. In my opinion, that's a bit too low. It's being more bullish on its analysis, only giving a growth rate of about 11 to 14% by 2030. I think that's too low, so I'm going to ignore that one. But let's go to DeepSeek. DeepSeek basically mirrors ChatGPT's answer, and I agree. 30, 33, 34, 35, that seems like the accurate number. When we ask Claude, it thinks 38 billion. That is a bit too low, especially the fact that it never hit the teens in growth in the past. I don't like to give a number to a company that it never hit in the past, even if we're doing future projections. So for me, Gemini and Claude estimates are a bit too low. I'm going to ignore those, and I'm going to go with about 35 billion because I feel like it can exceed 34. 35 is a more fair estimate for a company that's this well established and still growing. So that would mean that it would have a growth of 220% by year 2030. Next, we're going to go to the number of outstanding shares. Now, this company over the last 5 years has never, and I mean ever, done a single stock buyback. It has always diluted you. Recently, it started diluting you a little more than usual. I think that's because it started having this rapid growth and stock compensation started becoming a major factor. So I think in the near future, even though it's doing an average of 2% dilution a year, I don't think that's sustainable. As it starts to become more profit, stock-based compensation becomes a thing that starts doing less of. I think we'll only see a 2% dilution over the next 5 years. That might be a little too optimistic, but the trends seem to point that way because it's becoming more profitable. It's giving a higher base salary. It's not really reliant on those factors anymore. So 2% dilution over the next 5 years, it's very reasonable. It could be more, but that's just my opinion. Next, we're going to go ahead and take a look at the PE ratio for this company. Now, this company recently had a major drop off in PE after its earnings call because it missed on revenue. So it used to be selling for about 100, 140. Now it's like 130. At one point, it had a PE of 13,000, which is ridiculous. But the average number I am seeing for its PE is above 80. But you got to understand, this company was growing above 34% every year. So a high multiple and high PE made sense. Can it sustain this kind of growth pattern into 2030? No, it's going to hit the teens in my opinion. So I want to be a little bit conservative and say that it's going to have a PE of 37, not this 80 trend that we're seeing that it has historically or the 140 that it is current. Profit margin, It currently has a profit margin of about 13%, but that's because it's doing a massive reinvestment into the AI front. It wants to be one of the leaders in offering AI products and services, so that makes sense. If it wasn't for that, its profit margin probably in the 20, like 27, 28. So I think it will not only have a high profit margin, but it will increase that to 30%. Now, after we plug in all the numbers, we get a stock price of over 1800 by 2030, which means you will do 36% better than the S&P 500 if you were to invest in ServiceNow today. For you to get a full 2x return, you need to buy this company at $919 for a full 2x return. Now, in my opinion, this is a good stock to get at, even though you're not getting a 2x return, because its potential is limitless and we can't really calculate it. If you look at its current products and services, its digital workflow products account for 88% of its total revenue. It hasn't even touched the AI investments yet. It's pushing itself into it. Its IT operation management accounts for 11.5% of its revenue. Both of these sectors are going to continue to grow, not at that same accelerated pace, but it's going to continue to grow. And its major revenue stream that we can't even calculate, doesn't really have that strong of numbers, are its AI related products and services. Its AI power automation is growing above 23% a year. This could be a major revenue source for them in the future. Their enterprise subscription revenue is also growing by 23%. Also, this could be a major revenue boost for them in the future. Now, this company isn't without risk and it is very overvalued. But if you want to be someone that wants to be absolutely sure that you're going to get 2x return, wait for $919. If you're someone that's okay with a little less return, but you don't want to miss out on this amazing deal, I would jump in. Now, me personally, I want to wait a little more for a further pullback so I get a great deal. But don't just follow what anyone says on the internet. Do your analysis, do your own thesis. Let this analysis be a guide, but ultimately do your own research, do your investigation, and make your own decision. Please like and subscribe, and I'll catch you guys in the next one. Peace.